All right, welcome back, everyone. As I told you, I should have mentioned to all of you, we are using a brand new program to bring our core summit to life to become more engageful. I should tell you a couple of things. One, you can pose questions. That's right. We have people that will actually take your questions and make sure that our speakers are able to answer them for you. That's right. There's going to be polls that will be able to be taken as well. So we're going to make this as interactive as possible so you have a good time as well. So, as I said before, I am so excited today that you get to hear from the very person that started it all. We are here, that Dare to Dream idea is because of that vision that it took a decade ago and plus. And I'm very excited to introduce you all to Mr. David Weild IV, the current chairman and CEO of Weild & Co., the father of the Jobs Act. David Weild, it's yours, sir.
Thanks, Oscar. It's great to be here. Folks, just to give you a little bit of a sense, I'm in Nashville, Tennessee. My wife and I are moving down here. We have a daughter at Vanderbilt, so I'm in a hotel. So we're in the middle of move-in, so a little bit discombobulated. But for those of you that kind of don't maybe know the history, just give me a little bit. When I was vice chairman of NASDAQ, I was very concerned with some of the market structure changes that went on with our public markets that dropped the bottom out of support for small cap equities. And as a consequence, I started to write about that. And we had 80% of all initial public offerings in the United States were sub $50 million in size. And in a very short period of time, when they went to all electronic, narrow spread, narrow commission markets, the bottom dropped out of the aftermarket support there. And we went from 80% small IPOs to 20% almost overnight. And that was an observation that we made, that we published around. It also took the number of publicly listed companies in the United States from a peak of around 9,000. These are operating companies. Take the closed-end funds and the ETFs out of there. The actual employers of people went from 9,000 down to about 5,000. And we thought that was just not good for access to capital, innovation, and the like. And so we started speaking about it. And in Washington, we got the ear of quite a number of congressmen. They started to work on various forms of legislation, a whole series of bills. And then those were wrapped up, and it was given the name of the Jobs Act, and stands for Jumpstart Our Business Startups Act. It's actually an acronym. And we ended up with 6 titles, which were originally 6 separate bills wrapped into it. There were 7 titles total, but the 7th was a tag on to educate women and minorities on access to capital. And we created the emerging growth sector of IPOs, which was Title I, Reg CF, crowdfunding, general solicitation of private placements. So that was sort of the companion for traditional 506B, created 506C, and allows you to generally advertise private placements now, which was something that hadn't been able to do. Title before that, Regulation A+, which there was a very little known, very little used sort of exclusion from exemption from public registration called Regulation A, and it was capped at only $5 million in size. The Jobs Act took it up to $50 million and created a framework for information reporting. And so that's become increasingly more popular. It got moved up to, I believe, $75 million in aggregate proceeds during any 12-month period. And interestingly, the 2 countries that qualify for that are the U.S. and Canada. And we also took up the number of shareholders. I call it the Facebook effect, but once upon a time, if you had 500 or more shareholders in the United States, you had to publicly register your securities. And we took that cap up to 2,000. Actually, we recommended that they get rid of the limit because it was sort of our thesis was, why do you care if everybody is a member of a non-protected class like accredited investors? Why do you care what the number is? But it was easier to take the 500 in the legislation and just cross it out right in 2000. And as I subsequently learned. So I would say that we've had a great leap forward. One of the things that people generally don't understand, they expect that major legislation in capital markets is going to have an instantaneous effect on the amount of capital formation. And in point of fact, I think as all of us that are on this call know, it requires an ecosystem. And one of the things that we did in the United States and frankly Canada and a lot of other foreign markets by collapsing trading spreads and commissions and going all electronic is we took away a lot of the economic incentive for the smaller broker dealers. And as a consequence, a lot of them consolidated out of business. And we lost a lot of that ecosystem that really supported different forms of corporation finance. And so we're in the process right now because of the changes in the Jobs Act of starting to rebuild that ecosystem. Core Connects being a very prominent entry into that area, but others that are on this call like Rialto trying to make markets and securities and so forth. And we have to kind of build that back up rather gradually. All the crowdfunding sites, all of the 506B, 506C, Regulation A+ kinds of portals, and it's a lot easier to collapse an ecosystem than it is to build it up because it takes a lot more time to build one up. And we're in the rebuild phase. I would say that we've got a lot more work to do. We need other legislative initiatives out of Washington. I'd like to see a new stock market structure that would bring back economic incentives in the aftermarket to support small cap companies, because we've lost a lot of the brokers now from the industry that would actually market individual stock ideas on a steady state basis, and the research support. You need an economic model to pay for bringing all of that back. And we actually had some of that built into an act in Congress that got very close to getting passed. It was called the Jobs and Investor Confidence Act of 2018, and it went through the House 406-4. I mean, if you can imagine just how amazingly bipartisan that vote must have been, to have that lopsided a vote. I would dare say that you can't even get a proclamation in support of motherhood and apple pie through the U.S. House of Representatives today, 406-4. It went over to the Senate. It was supported by the Trump administration at the time. And the word in Washington was that it was supposed to get tacked on to the Senate appropriations bill. That never happened because President Trump shut down the U.S. government over building the wall, and then pushed that legislation into the next Congress, which has the effect of setting that legislative clock back to zero. But I think what I would tell you is that there is a great appetite in Washington to do things that are going to improve capital formation. And I would posit that for those of us that are of free democratic countries, that we all collectively, whether it's in Western Europe, North America, Latin America, we all have to kind of get our collective regulatory acts together to create the incentives, to give the entrepreneurs the tools that they need to raise capital, to innovate. There's no crime for failing if you're doing it honestly. And we need to get more people starting more companies. One of the little known sort of facts that came out of the U.S., I think it was the U.S. Census Bureau, Department of Labor, I'm not sure which, was that we had a big decline in the rate of startups in the United States. And we see that sort of trend having occurred in most of the heartland kinds of states in the United States. California did a really great job of understanding that the small IPO market was largely lost to it. So it started creating big pools of later stage capital, which created then in turn the unicorn phenomena. But I would say that even now, with 800 unicorns in North America, and an average of 120 or so, 120 to 140 initial public offerings a year, most of those companies are just too big to be acquired, that we're really going to have to take a wholesale relook at fixing these IPO markets again. It's something that I'd like to contribute to. But bringing it back to Reg CF, 506C, Regulation A plus. I mean, there's an opportunity now to get more businesses started, to broaden the ecosystem, to start creating greater connectivity, which is one of the things that sort of excites me about what Oscar is doing. That the more Regulation A plus and Rialto and other entrants is that the more of the street and the more of more investors that we can get connected in, the more valuable these networks essentially become, and the greater the likelihood that we're going to fund more and more earlier stage businesses, which in turn gives us the opportunity to create jobs, upward mobility, and hopefully, since much entrepreneurial activity is focused on social impact companies, to solve great challenges of our time, whether it's in life sciences and medicine or climate change. I firmly believe that the solutions for climate change are apt to come from scientists and engineers who've cracked the code on cutting emissions or taking CO2 out of the atmosphere. And so from where I sit, getting more entrepreneurs funded is going to be important to having a better and better chance of leaving a respectable environment for the next generation. I would tell you that there is an essential need for a public market to migrate to that will do a better job of supporting smaller capitalization companies. There is something called in academics, it's just a worthwhile concept, and it'll help everybody kind of understand the answer to the riddle of, why are markets broken if large capitalization stocks seem to trade so efficiently? And the answer is that there's something called the network effect, and large capitalization stocks benefit from what we call symmetrical order books, which is lots of buyers and sellers in the electronic market at any point in time. So, Intel, Microsoft, ExxonMobil, they're not lacking orders at any particular point in time. And there are a lot of eyeballs on those stocks, but the typical microcap security, which is, I define a microcap security as something under $500 million in market value, is an asymmetrical order book security, big seller, no buyer. And if there aren't liquidity providers that can make a market in size, then fundamentally oriented institutions that do their homework leave those markets because there's too much slippage when they try and get into the stock and sell it, and the shorts get on the other side of the market, and the stock that they wanted to get out at $10 a share, is all of a sudden trading at $7 a share. Or if they're trying to buy the stock, they get ahead of it and they move the stock up. And so this notion of having low transaction costs is one of the great sort of myths. And, it's a complete lie, because what isn't factored into transaction costs is that so-called slippage element. And so if you do studies, which we have, of over time of fundamentally oriented institutional ownership of microcap, small cap securities, you'll find that most of those high quality long-term investors have gradually moved their allocations to larger capitalization securities because they just can't get enough of these stocks in a hyper efficient, low cost trading market. It just doesn't facilitate the kind of liquidity that institutions need for bigger bites. It's been almost 10 years. It's going on since we got the Jobs Act passed in Congress. I was in the Rose Garden. I think some other folks are going to be speaking today. We're at the White House Rose Garden. It was a beautiful event when President Obama signed the legislation into law, the act into law. And one of the things that people, may not recognize is that pretty much the only title of the 7 Title Jobs Act that was immediately effective was Title One, because it was sort of broadly elucidated, and that was what created the emerging growth company designation into public markets. But the rest of them were essentially remanded by Congress over to the Securities and Exchange Commission for rulemaking. And so to varying degrees, it took years just to get the core rules into the market. And I think the final rule was at least 4 years after the signing of the Jobs Act, so call it 2016, maybe even 2017, before people could actually set up businesses. So there's been a bit of latency in terms of getting it into the market. And I think really now we're just starting as an industry to sort of hit our stride in figuring out how to basically make these things work. I'm going to give you, if you don't mind, just a couple of minutes of thought, in the news you can use category around Regulation A plus. Regulation A plus allows you to raise up to 75 million with public investors. It's an exemption from registration, although there is a sort of a registration light now that you have to file with the Securities and Exchange Commission. And I think it's a healthy thing. But what I would tell you is that by definition, these deals are going to be micro cap in nature. And so to the extent, so that they're going to have a lot of the same aftermarket trading problems that others do. So it's a couple of things you can think about doing with Regulation A plus, which is one, restrict them and so that the shares don't trade, or if they do trade, you have to give some real thought to what the aftermarket support model is going to be. And for us, sometimes that's the choice of security, so that if the security is more bond-like, whether it's real estate investment trust, real estate assets, yield-oriented, they tend to trade better because people can value sort of asset-based securities a little bit more easily than growth companies, where you put a coupon on it or some kind of a distribution. But those kinds of things also are going to help aftermarket trading to the extent that you can create a marketplace which is more quote driven and not electronic, and that may vary from jurisdiction to jurisdiction, and so that people can brokers can make money and like we used to 2.5% on writing a ticket with an individual investor, or getting on the phone and then doing it the old-fashioned way, which is going out and finding an investor and saying, we have a research report on this stock is attractive in our view. Wouldn't you like to purchase it? Because in the old days, we created spot liquidity by taking, say, a block of 500,000 shares that an institution wanted to get out with a buy recommendation we'd have on the stock, and we'd hold the stock, say, at its price of $10 a share in a telephone quoted market, with a quarter-point spread in it. So on the ask side of the market at 10 and a quarter, and we'd actually price it net to the broker who brought in 1,000 share order, for instance, and write 500 1,000 share tickets to break up that 500,000 share block, and every broker would make 2.5%, the difference between the bid and the ask on the market. That's the part that's kind of lacking from the market, which I think is essential, or will be essential to get back in, which is the economic incentive for brokers to be able to, hold share prices in place while that big block of stock is coming into the market, and then breaking it up and selling it to investors in small clumps, so that you end up with spot liquidity to offset a large seller. If we can do that, we'll get everybody back into business in a big way, because strong aftermarkets are absolutely essential to investors wanting to take initial public offering risk. And if we can get these aftermarkets better supported, then it'll make it very, very interesting for everybody to start building the infrastructure to support taking smaller companies public, whether it's through Regulation A+ or any other modality. Okay. I'm going to turn it back over to Mr. Joffrey. I hope that was helpful. I want to encourage everybody to keep innovating and moving these businesses along. You're part of that essential economic infrastructure that we are all going to need to drive our economies over the forthcoming decades. And you're doing a real by participating in these markets and trying to figure out how to make them work better. You're doing what we used to call the God's work of investment banking. So my hat's off to everybody.
What an interesting way to end that. That is so true, though. It's not only the ecosystem, but it's also the people that are actually engaging with these companies, participating, investing, and because they didn't have to, right? You know that nobody put any pressure on them other than they're supporting these great innovators out there in the market. And I applaud you. It is amazing how time has flown. I joke around. I can't believe 12 years has gone by. It obviously this time there's a lot of things that needed to happen in order for entrepreneurs to be able to take advantage of these regulations. A lot of work has been done. You're going to hear about that today. So David, thank you as always. Looking forward to, what do they say, the next big monumental event that happens within the Jobs Act and that helps entrepreneurs and investors alike coming together. So we're just going to end the session. As you all know, we ended, and then don't worry, you're going to be taken into the backstage or the lounge. My apologies. Now, I understand some of you are having some problems listening. The best thing to do is please refresh. For some reason, it happened just a couple times for people. So we're going to make sure this time the pause is going to be about 3 to 5 minutes. So it gives everyone time to refresh their screens and all that. We'll be seeing you very soon. Thank you.